There's a tax planning mistake that's completely legal, entirely avoidable, and can cost you over $50,000 in unnecessary taxes. And most people make it without even knowing they had a choice. It's called the 2 RMD trap. And if you're turning 73 in the next few years, you need to understand this now before the deadline passes. My name is Jonathan Peters. Over the past 25 years, I've watched dozens of retirees trigger this trap accidentally. They follow the IRS rules perfectly. They think they're doing everything right, and then they get hit with a massive tax bill that could have been completely avoided. Now, this isn't about breaking rules. It's about understanding the hidden consequences built into those rules. Consequences the IRS doesn't advertise, and most advisors never explain it until it's too late. Here's what happens. When you turn 73, you're required to start taking required minimum distributions from your traditional IRA and 401k accounts. The IRS gives you until April 1st of the following year to take your first RMD. Sounds generous, right? You have extra time to plan. Now, here's the trap. If you use that extended deadline for your first RMD, you still have to take your second RMD by December 31st of that same year. That means 2 full RMD withdrawals in one single year. And here's why that matters. Taking 2 RMDs in 1 year can push you into a higher tax bracket and significantly increase your overall tax liability for that year. Let me show you what this looks like in real numbers. So for example, in scenario 1 here, you take your first RMD by December 31st of the year you turn 73. Okay, 1 RMD equals $45,000. You stay in the 22% tax bracket. The tax hit is roughly about $10,000. Scenario 2, you wait until April 1st of the following year, 2 RMDs in 1 year, so that's $45,000 plus $47,000 equals $92,000. Now you're pushed into the 24% tax bracket, possibly higher. The tax hit here could be $25,000 or more. So the difference is over $15,000 in unnecessary taxes. And that's just 1 year. The damage compounds because higher income can also trigger higher Medicare Part B premiums with IRMA surcharges, taxation or more for Social Security benefits, and a potential loss of other income-based deductions. In over 40 years of watching Wall Street boom and bust cycles, I've seen this trap hurt people again and again. Not because they were careless, because nobody explained the full cost of that generous deadline. Now, here's what this really means for you. You don't have a deadline problem. You may have an income architecture problem. Your money isn't positioned for strategic tax efficient withdrawals. And until you build proper income architecture into your retirement plan, you're going to keep making technically correct decisions that cost you tens of thousands of dollars. You need a withdrawal strategy designed for tax optimization across multiple years, not just compliance with current year's rules. Now, this is exactly what step 5 of my life-tested retirement system is designed to prevent. This means mapping out your withdrawal strategy years in advance, so you're controlling your tax brackets, not reacting to RMD deadlines. Here's what proper income architecture includes. First, understanding your complete RMD timeline before your first distribution is due, so you can plan withdrawals strategically across tax years instead of cramming them all together. Second, building a multi-year tax projection that accounts for RMDs, Social Security timing, Medicare premium thresholds, and other income sources, so you see the full tax picture, not just this year's tax bill. And third, creating intentional withdrawal sequencing that minimizes lifetime taxes, not just current year compliance. Because here's the reality. The IRS rules are designed for their benefit, not yours. The April 1st deadline isn't a gift. It's a trap door most people fall through. There's also another risk. If there's a market downturn after your RMD is calculated based on the prior year's higher account balance, you could be forced to sell investments at a loss just to meet your RMD obligation. That's why this is an option. It's the difference between paying what you must and paying far more than you should. Click below if you're within 5 years of RMD age and you've never seen a multi-year tax projection for your retirement withdrawals. You may be at risk. Click below to schedule your adaptive retirement call today.